Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, we have an interesting sort of set of weeks coming up ahead of us with two major central bank decisions. Next week, we have the European Central Bank, which meets to set policy. And of course, the big question here is whether they indeed end up cutting rates well ahead of the Fed, and of course, what that means for bond yields and the euro currency. That's, of course, turning out to be quite a big focus. It's a similar question, of course, for the Bank of England thereafter. But of course, over there, the last inflation picture certainly muddies the picture a little bit more so. So, few central bank decisions are beyond the Fed. So, how significant could these meetings be, and how should investors think about responding? To discuss this and more, today I'm joined by Audrey Go, who's the head of asset allocation at the CIO office. So, welcome, Audrey. Thanks for taking the time to join us today. Let's start with equity markets, though, before we come to central banks. Markets seem to be consolidating after what was a previously setting of new record highs. Should investors worry about a reversal, or is this really just a consolidation before the rally extends?
Well, the likely triggers for the latest consolidation are higher bond yields, and that follow a pretty strong set of US economic data, and of course, a weak government bond auction, and of course, hawkish comments from Fed's official as well. In our view, the global as well as US stocks are likely undergoing a healthy phase of consolidation after scaling recent highs. If you look at economic data in May, those have came in surprisingly strong after a slowdown in April. Manufacturing sector broadly improved in the US, UK, Europe, and even Japan. And US consumer confidence, as measured by the Conference Board, also surprisingly rebounded in May after 3 straight months of decline. So I think that's in no doubt due to still a pretty robust set of job markets we see in the US today. So overall, the US economy continues to grow at a pretty healthy clip. And if you look at the latest Atlanta Fed GDP now estimates, they now have Q2 24 growth estimates at 3.5%. So we do see room for the equity as well as bond market gains to extend. And if we look to the earnings season as well, those have also came in better than expected, with consensus actually revising up their 2024 full year earnings growth estimates higher to 11%, and 2025 estimates to about 14%. In terms of the sectors leading this earnings upswing, no surprise, the technology and communication services sectors are in the lead, both with an anticipated 18 and 23% earnings growth in 2024. And this basically support our continued preferences for these equity sector. Now, if we talk about risk, the key risk to this sort of sanguine view that we have today is really much higher bond yields from here. And what's key for investors to watch is really the 5% yield level on both the US 10-year as well as 2-year government bond. This 5% level has acted as a self correcting moderator of near term financial conditions over the past year. So, any sustainable break above the 5% mark will likely suggest a shift from the current not too hot, not too cold Goldilocks regime, which has been supportive of risk assets. And on the downside, the key level to monitor is really 3.8%, which was the lowest by the 10-year bond yield last December. So that level offers a strong support in our view. So a break lower from this level would then suggest a likely deterioration in economic conditions and therefore a weaker job markets as well.
Thanks, Audrey. While staying on the topic of equity consolidation, what about the Hang Seng? Is that also, in your view, in a consolidation phase?
Yes, we believe so. Over the last 2 months, Chinese equities have benefited from a significant fund rotation away from previous regional outperformers such as Korea and Taiwan, as well as globally from US equities. And we've also seen China economic data outperforming given low expectations, while the US data have been underperforming due to high expectations. And that has largely resulted in the Chinese equities outperforming the US ones since the end of Q1 24. However, after the strong corporate guidance following the US earnings season in first quarter, as well as some signs of softer inflation coming through in the US as well, that has basically helped US equity market to return to a more Goldilocks environment. In the case of Chinese equities, the normalization of excessive investors' pessimism towards China assets, Chinese equities, as well as renewed fears of a US-China trade war following the imposition of limited US tariffs on Chinese exports. That basically means that the Chinese equities may no longer be the low-lying fruit or low-hanging fruits they once were. So, in terms of technical, in the very short term, we do believe that the Hang Seng Index is testing key critical support, and we see the next level of support at 17,690, and therefore presenting tactical opportunity for investors to buy near that level. And this level is also very close to the 38% Fibonacci retracement of the range since the middle of April 24. And if I look at our technical model, which has captured most of the recent rebound seen in Chinese equities, that remain positioned bullish for the next 3 months as well, given that the overall price trend that we see today is still largely positive, as reflected in the rising 50-day moving average, as well as higher upside volatility since the breakout in Chinese equities.
Okay, so let's move on to bonds and the ECB as we started this conversation. Bond yields, of course, in Europe has also surged. Do you see any near-term catalysts for those to come lower and potentially trigger some euro weakness?
So we believe there is a high chance of a ECB rate cut in June, ahead of the Fed. So European government bond yields have also recently surged as the ECB policymaker have suggested that their rate decision remains largely data dependent, and also German inflation in May came in higher than anticipated. Nonetheless, the increase in yields, in our view, has arguably enhanced the risk reward balance for European government bonds. And if you look to the German inflation, that is also likely one off because of low base effects, and core inflation overall is likely to ease. Therefore, we do believe that a renewed easing in inflation expectations should allow the ECB to ease policy, therefore lifting the prices of European government bonds. We therefore continue to maintain a buy view on European government bonds, importantly on a currency hedge perspective, and we'd also expect the Euro US dollar to move lower. So if you look at the Euro US dollar, it has been trading largely in a descending channel with lower highs, lower lows since the start of the year. So should the ECB signal a dovish interest rate path at its policy meeting next week, we would then expect the pair to trade largely range bound but with a modest bearish bias, with the next near-term key support at around 1.069.
Okay, and finally, maybe just turn to the UK. We've, of course, had the announcement of an upcoming UK election. Do you see that having an impact on UK equities and the pound sterling?
So if we look at the current polling results, it currently indicates around a 20% lead for the Labour Party. So this suggests that a change in government is likely. Having said that, we do believe that investors will continue to watch out for the party manifesto, which is expected by early to mid June, particularly on tax policies as well as their relationship with the EU. So overall, we do not expect a significant impact from the election on large cap UK equities, as these categories of equities generate more than around 80% of their revenue from outside of the UK. And the UK equity market overall offers lower earnings growth compared to global equities. But this is, of course, offset also by a equally deep valuation discount as well. So overall, if we look at the UK, it has a largely defensive tilt, and we do expect the UK equities to perform largely in line with global equities over the next 6 to 12 months. Then moving on to the currency side, if we look to the pound, the nominal effective exchange rate, or the near in short, remains very resilient, which basically indicates limited concern from the currency market perspective. And if you look at the Labour Party, they were previously in power between 1997 to 2010 period. With also no clear evidence that they impacted the pound's direction. So we do believe that a greater impact on pound US dollar is likely to come from the Bank of England as well as the Fed monetary policy. And after the higher than expected UK inflation print over the past month, markets are now expecting a UK rate cut only in late third quarter of this year. This basically suggests room for the pound to fall if either of these expectations are brought forward once again, or the Federal Reserve rate cut outlook is being delayed. So from a near-term perspective, we do see downside in the pound to about 1.21 over the next 3 months.
All right. Well, I think we're almost out of time, so we'll end the conversation there. Thanks so much, Audrey, for taking the time to speak to us today. As always, if I can just summarize some of the key takeaways from today's conversation. First of all, the pullback in equities, in our view, a healthy consolidation, something to potentially buy into if you're looking to add exposure. Second, in Europe, the ECB potentially preparing for rate cuts, which of course explains why we have a bearish bias on the euro dollar. And we think euro government bonds are a buy on an FX hedge basis. And third, of course, we think the pound sterling also has room to move lower. But of course, that's more dependent on rate cut expectations shifting rather than UK elections, which may not have such a big impact. So we'll bring it to an end there. Thanks very much, as always, for taking the time to dial in. We wish you a great weekend ahead and look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.